When it comes to the question of paying off your student loans, I definitely wouldn't recommend that somebody just go ahead and do that before talking to a mortgage lender at all, because it depends on what the goal is, right? It's understandable that somebody just wants to pay off their debt. But when it comes to the qualifying for a mortgage piece, the status of your loans right now might not be having much of an impact on your eligibility at all as they stand. And so if the question is, let's say you got $50,000 in student loans and you have $50,000 that you're willing to put towards paying off the student loans, what if we took that money and put it somewhere else instead? If you were to, say, make an additional down payment, that's going to lower the monthly payment of the mortgage, of course. Or if you were to take some of that money and buy, say, a lower interest rate. If the goal in, say, paying off the student loans is for monthly cash flow, right? You want to just eliminate that monthly payment that you have, let's call it $100 a month. Well, depending on the price point of the house and the mortgage amount, if you take $10,000 and put it towards buying down a lower interest rate, that could have a much bigger impact than $100 a month. You could be talking $150, $200, $250 a month in savings on your monthly mortgage payment. So from a cash flow perspective, you're much better served actually taking even less of that money and just putting it towards the mortgage structure. And we're not, of course, financial planners, and we don't act as that, but the recommendations and things that we are aware of are around that broader financial picture. Hey, if you just want personally to eliminate student loan debt and to stop paying interest and not have that monthly payment, totally get it. Let's talk about, though, if you were to take that money away from being able to be utilized in the mortgage financing structure, here's what the impact would be, versus if you did apply it to the financing structure, this is how it could impact it.
I love that topic. How negotiating on a particular property plays into this too.
Yeah.
And so one thing that is a negotiation point is buying down that interest rate. So we're talking about buying down that rate using points. A point is a percentage of the loan amount. I won't speak for a lender, but I don't think the lender cares who pays that. It could be a buyer, it could be a seller. So it can be a really intriguing negotiating strategy to ask, if you're a buyer, ask the seller, instead of even a lower sale price, making a contribution toward buying down the interest rate to make your monthly payment more affordable. And that little, I mean, it might be a couple thousand, $3,000, $4,000, which that's $4,000, but it's really not that much in the big scheme of the purchase price of a property, but it can make a huge difference in the monthly payment and the qualifying ratios. So like that's a conversation that we love having with our buyers. You know, here's the assets that I think I have. You've got more assets because there's negotiating that we can use to help get buyers more than they think a lot of times.